We all need financial services. We deposit our hard-earned money. We take loans to buy homes or cars. We invest to grow our wealth. This is where banks and non-banking financial companies, or NBFCs, come in. They are the backbone of our financial system. Banks are the traditional players. We all have bank accounts. We rely on banks for various services. These include loans, credit cards, and investment products. NBFCs, on the other hand, are like specialized shops. They offer a narrower range of financial services. They focus on specific areas like lending, asset financing, or investment management. Both banks and NBFCs play a crucial role in the economy. They provide much-needed credit. They fuel economic growth. Understanding their differences is vital for informed financial decision-making. Whether you're depositing your savings or seeking a loan, knowing where to turn can make all the difference. The main difference lies in their scope of operations. Banks are like department stores. They offer a wide range of financial products and services. NBFCs are more like boutiques. They specialize in specific areas. Banks are heavily regulated by the Reserve Bank of India, or RBI. They need to follow strict guidelines. This ensures the safety and stability of the financial system. NBFCs also fall under RBI's purview. However, they have relatively relaxed regulations compared to banks. One key distinction is that NBFCs cannot accept demand deposits. These are the deposits that you can withdraw any time without any prior notice. This limits the ability of NBFCs to create money, a power held by banks. Another difference is that not all NBFCs can issue checks drawn on themselves. This further differentiates their operational capabilities from banks. Understanding these key differences is crucial for investors. It helps in assessing the risk and reward profiles of banks and NBFCs. It allows for informed investment decisions based on individual financial goals and risk appetite. Banks and NBFCs need money to lend. This is where their funding sources come into play. Banks primarily rely on public deposits. When you deposit money in your bank account, you are essentially lending it to the bank. This forms a major chunk of their funding. NBFCs, on the other hand, rely more on market borrowings. They raise funds through various instruments. These include bonds, debentures, and commercial papers. They also borrow from banks and financial institutions. This difference in funding sources impacts their cost of funds. Banks typically enjoy a lower cost of funds due to their access to public deposits. NBFCs, with their reliance on market borrowings, often face a higher cost of funds. This difference in funding costs influences their lending rates. Banks can often offer loans at slightly lower interest rates compared to NBFCs. However, the competition in the market and other factors also play a role in determining final lending rates. How do we measure the performance of banks and NBFCs? Three key metrics help us: return on equity, or ROE, return on assets, or ROA, and net interest margin, or NIM. ROE tells us how efficiently a company utilizes shareholder funds to generate profit. A higher ROE indicates better profitability. ROA measures how effectively a company utilizes its assets to generate earnings. Again, a higher ROA is desirable. NIM is the difference between the interest earned on loans and the interest paid on deposits. It reveals the profitability of a bank's or NBFC's core lending business. A higher NIM signifies better earnings from lending activities. These metrics are crucial for investors. They provide insights into the financial health and profitability of banks and NBFCs. By analyzing these metrics, investors can make informed decisions about where to park their money. Section 5. Navigating the risks, the NPA threat. Investing involves risks, and banks and NBFCs are no exception. One of the biggest risks they face is the rise of non-performing assets, or NPAs. NPAs are loans on which borrowers default on repayments. When NPAs increase, it directly impacts the profitability of banks and NBFCs. They have to set aside more money as provisions for these bad loans. This reduces their earnings. Several factors contribute to the rise of NPAs. These include economic slowdown, poor credit appraisal processes, and willful defaults. It's crucial for investors to assess the NPA levels and asset quality of banks and NBFCs before investing. Look for institutions with strong risk management practices. Check their track record in managing NPAs. A prudent approach to risk management can mitigate the impact of NPAs. It ensures the long-term sustainability and profitability of these financial institutions. Section 6. Investing wisely. An outlook on banks and NBFCs. The financial sector is ever evolving. Factors like economic growth, interest rates, and regulations impact the performance of banks and NBFCs. Despite the challenges, both sectors offer investment opportunities. Banks, with their vast network and diverse product portfolio, are considered relatively stable investments. They are well regulated and enjoy a strong market position. However, their profitability might be impacted by factors like rising NPAs and increasing competition. NBFCs, particularly those in high-growth segments like consumer finance and housing finance, offer higher growth potential. They are nimbler than banks and tap into niche markets. However, they are also more susceptible to economic downturns and regulatory changes. Investing in banks and NBFCs requires careful consideration. Evaluate factors like their financial performance, asset quality, management track record, and growth prospects. Diversifying your investments across different institutions can help mitigate risks and optimize returns. Section 7. High risk, high reward, microfinance and regional banks. Within the banking and NBFC space, microfinance institutions and regional banks stand out. They cater to specific customer segments and carry unique risks and rewards. Microfinance institutions, or MFIs, provide financial services to low-income individuals and communities. They offer small loans, savings accounts, and insurance products. While MFIs play a vital role in financial inclusion, they operate in a high-risk environment. Their borrowers often lack credit history and face economic vulnerabilities. Regional banks, as the name suggests, primarily operate in specific geographic regions within a country. They cater to the local population and businesses. While regional banks benefit from local expertise and customer relationships, they are also more susceptible to regional economic downturns and localized risks. Investing in MFIs and regional banks can generate high returns due to their focus on underserved markets. However, investors need to be aware of the higher risk associated with these institutions. Factors like political instability, natural disasters, and local economic conditions can significantly impact their performance. Section 8. Finding the sweet spot advantages of mid-sized players. In the spectrum of banks and NBFCs, mid-sized players often present a compelling investment proposition. They offer a balance between growth and stability. Mid-sized banks often exhibit higher growth rates compared to their larger counterparts. They are eager to expand their market share and tap into new customer segments. Their smaller asset base allows for greater agility in responding to market changes and adopting new technologies. Similarly, mid-sized NBFCs often focus on niche sectors experiencing rapid growth. This targeted approach allows them to capitalize on emerging opportunities and achieve significant market penetration. They are less bureaucratic than larger institutions, enabling faster decision-making and innovation. Investing in mid-sized banks and NBFCs provides exposure to growth potential while mitigating some of the risks associated with smaller players. Their focus on technology adoption and customer-centric approaches further enhances their appeal to investors seeking long-term value creation. Section 9. The technology takeover, reshaping the banking experience. Technology is revolutionizing the banking and finance landscape. Digital banking, mobile payments, and artificial intelligence are transforming how we manage our finances. Banks and NBFCs are leveraging technology to enhance customer experience, streamline operations, and drive innovation. Digital banking platforms offer the convenience of banking from anywhere, anytime. Mobile payments are gaining traction, reducing our reliance on cash. Artificial intelligence and machine learning are being deployed to improve credit scoring, detect fraud, and personalize financial services. These technological advancements are creating opportunities for new entrants and disrupting traditional business models. Investors need to pay close attention to how banks and NBFCs are adapting to this technological revolution. Those who embrace technology and innovate continuously are more likely to thrive in the long run. Look for institutions that prioritize digital transformation and invest in building robust technological infrastructure. Section 10. Embracing the future of finance. The financial services industry is on the cusp of a digital revolution. The lines between banks and NBFCs are blurring as fintech companies enter the fray, offering innovative solutions. Open banking, blockchain technology, and peer-to-peer lending are just a glimpse of what the future holds. This evolving landscape presents both challenges and opportunities for investors. Staying informed about the latest trends and understanding their potential impact is crucial. Look for institutions that embrace innovation, collaborate with fintech companies, and prioritize customer centricity. The future of finance belongs to those who are adaptable, innovative, and customer-focused. By aligning your investments with institutions embracing these principles, you can position yourself for success in the exciting world of banking and finance. Remember, knowledge is power. Stay informed, stay engaged, and make wise investment decisions.